A more hawkish than expected Fed statement has sparked significant trading action in a number of markets today. The Fed has announced that it does plan to start reducing its balance sheet production program in October. This is as the market was generally expecting. What's more significant, however, is the dot plot in the member expectations for interest rate increases. The Fed members did indicate with 11 of the Fed members indicating that they still expect to see one more rate hike this year, most likely in December. On top of that, half a dozen Fed members indicated that they expect to see 3 more hikes in 2018, with a number of the 3 members calling for 4 rate hikes next year. This 3 to 4 was for 2018 would mean a continuation of the 3 to 4 rate hikes that had been the party line for 2017. The reason the Fed goes for 3 is it gives them some wiggle room in case something happens, particularly on the political side. On the political side in the U.S., it's looking like with the recent deal between Trump and the Democrats on the budget and them talking about immigration and other policy areas, tax reform starting to come together and things like that. Some of the risks that the political turmoil in the U.S. could spill over and impact the economy through the debt ceiling or a government shutdown is starting to fade a little bit. This is opening the window back up for the Fed to take action. So this year now the Fed's looking at 3 rate hikes plus the start of balance sheet normalization. This is also starting to weigh a little bit on indices. It's important to remember that quantitative easing and all that money and low interest rates and all that money the Fed plowed into the system has been rocket fuel for the stock market over the last several years. We're starting to see things roll over, however, particularly in the highest momentum index, the Nasdaq 100. We'll take a look at it here. We can see that over the last few weeks the index has leveled off, and today it's actually starting to roll over a little bit. And in particular, it has started to come down since the Fed decision at 2 p.m. Eastern. Momentum starting to turn downward. And it's also following a breakdown in its largest component stock, Apple. Look at this. Apple has been basically trending higher for the last year. If you look, though, over the last 6 weeks or so, there's been signs of some topping, but most particularly here, RSI was showing upward momentum slowing. What are we getting today? We've got a gap down, breakdown through the 50-day moving average, Apple continuing to trend lower. Confirmation from the RSI, broken 50, accelerating to the downside. What's gone on with Apple? Why are people getting negative? People are starting to get worried about iPhone sales. The iPhone 8, some brokers have suggested, is not selling as well as the 6 and 7. It's possible that iPhone 8 sales, either people are getting tired of upgrading all the time, or iPhone 8 sales could be getting cannibalized by people waiting for the iPhone 10. The launch of the 10 has been delayed to November, and there's talk that there could be limited supply, so that could impact Apple's sales in the coming quarter and heading into the holiday season. So people are starting to pull the ripcord on Apple shares here. So between the double whammy of a potentially more hawkish Fed than people had been thinking, plus Apple sinking under its own internal fundamental issues at the moment, is starting to drag on the Nasdaq 100 index as well.